Gene Goldman, and here's a look at the week ahead for the week of March 20th. Last week was very volatile for the stock market. In terms of markets, were focused on the concerns about the U.S. banking system. A lot happened last week, and we can spend hours discussing what took place. But there are really three key issues. Number one, some banks were very concentrated or over-concentrated in one economic sector. For example, one bank was really focused on the technology sector. With technology spending slowing, tech companies could not get new financing, so they took money out of their bank accounts to pay bills. This caused deposits to slow or even reverse at these banks. Number two, rising interest rates. The Fed is raising rates. So with rates moving higher, people moved money from savings accounts to higher yielding investments like money market funds. This also caused deposits at banks to slow or even reverse. The third issue is that really banks violated Banking 101 rule. Never borrow short and lend long. So basically what happened is that the banks bought long-term treasuries, but with interest rates rising, prices of these treasuries fell. And it's important, this is very important, banks did not take credit risk because they invested in US government securities. But what they did do is they took what's called duration risk. They basically had too much interest rate sensitivity on their balance sheet. So with treasuries lower because of higher rates, banks were also under deposit pressure, so they're forced to sell these treasuries on their balance sheets at a lower price. A lot of this could have been avoided if they just bought short-term US Treasury bills, like 90-day Treasury bills. But anyways, the Fed raising rates, the Fed is likely going to break something, and it looks like they finally broke something. As a reminder, we wrote 2 commentaries last week to discuss what happens. To see these commentaries, please contact your Cetera Financial professional or go to on Twitter, Cetera IM. So let's turn to this week, and we will see some economic data, and the banking crisis will be in the headlines, but really all eyes will be on Wednesday's Fed meeting. So let's start with the consensus in terms of what the Fed will do. Based on probabilities, over the weekend, there's a 62% chance the Fed raises rates by 1/4%. A lot of caution about these numbers because there's a lot tied to news about the banking crisis. So this number, this probability will be very volatile until Wednesday. So keep that in mind. So the Fed meets on Wednesday. 3 takeaways that we expect from the Fed meeting. Number one, the Fed should not raise rates, but they will likely raise rates by 1/4%. Why should they not raise rates? First of all, markets are on edge. Number two, the Fed needs to assess what has already happened to the economy. Number three, there's potential for more stress to the banking sector. If you look at the Fed's weekly balance sheet report, there has been a huge surge in emergency loans at the discount window. Basically, banks are borrowing money on an emergency basis. 2 weeks ago, it was 15 billion. Last week is 318 billion. That's a huge surge in just a week. So again, these are banks borrowing money on an emergency basis. To put this in perspective, last week we're at 318 billion. During the peak of the pandemic, this number was only 130 billion in April of 2020. During the great financial crisis back in 2008, the peak was 437 billion. So there is a lot of stress in the banking system today, given these borrowings from banks. So the Fed will likely raise rates by 1/4%. And keep in mind, if we didn't have these banking issues, given the fact that we've seen strong economic data, most likely the Fed would have raised rates by 0.5%. So why 25 basis points? Why 1/4%? Well, the Fed will likely prioritize price stability over economic growth. Second of all, if they don't raise rates, it suggests that they're really worried about the banking system. And third of all, just a week ago in congressional testimony, Jay Powell, the head of the Fed, said he was very worried about inflation. So again, that's the first point. The Fed should not raise rates, but they raise rates by 1/4%. The second takeaway from the Wednesday meeting is that in the Powell press conference, we expect Jay Powell to stress flexibility in future Fed policy, that he and the rest of the Fed will adjust rates depending on data and if the banking situation worsens. It's important. And number three, the dot plot. Remember, the dot plot is that report that shows where the Fed expects interest rates to go and the economy and so on. We do expect the dot plot to keep the Fed funds rate at the end of 2023 at 5 1/8. Basically, no change in terms of the dot plot, in terms of where rates should be at the end of 2023. We do expect the Fed to kind of slow economic data down a bit again, but really overall, the dot plot should be less hawkish, should be a little bit more conservative. So our overall takeaway is that a lot that the market is worried about, particularly around the banking crisis, will it spread? But just as important for markets in terms of what will be on a go-forward basis is Fed interest rate policy. The Fed should not raise rates, but they will likely raise the rates by 1/4% But the good news is that the market has already priced in a 1/4% rate hike in this Wednesday's meeting, and the market does not like surprises. Thank you for listening. I know it was a really long recording this time, but thank you for listening. For more information, please follow us on Twitter at Cetera IM, and we'll see you next week, and thank you.